Let's have a look. Yeah, that's all good. Excellent. So we'll start it. We'll just give a few more people joining. We'll just give them a minute and then we can kick off.
Okay.
I'm trying to work out how I can rename myself because my name's coming up blank. But I think hopefully everybody knows who I am now that we're on week 7. So let's begin. So welcome, ladies and gentlemen. Thank you very much for joining for Fintech Summer Session week 7. We're already on week 7. And this week is all about capital markets. We're really pleased to have Dominic Stanyer with us. Dominic is part of Accenture's team and leads on a lot of the capital markets activities. And so he's going to walk you through a presentation. And as ever, if you've got any questions, please do add them in the Q&A, and we'll go through as many questions as we can throughout at the end of the session. So without further ado, I'll hand it over to Dominic.
Thank you, Saga, and hello, everybody. Okay, I guess just to kick us off, I know you've spent a number of weeks learning about a number of topics, and I think we all experience technology disruption and change, particularly in the financial services and particularly in banking. You know, today we all have our mobile phones, we can look at our balances, we can do money transfers into different currencies, we can make payments with our phones. And over the last 10 years, the services that bank offers to us as consumers has radically changed. But when we look at another part of the financial services industry, the capital markets, that's much more sort of esoteric, much more difficult for us as kind of customers to really get our heads around and really understand. But it's fair to say that technology always has and continues to disrupt the capital markets as well, arguably more than some of the retail services that me and you see every day, you know, living and working in Saudi and anywhere else. So today, what I really want to do is talk about, well, what are the capital markets? What really are they there for? And then who are the key players within it? There's lots of participants. It's very complicated, and it can be very difficult to understand how it all fits together. So we're going to touch on this, who those players are, what their requirements are, what their purpose is, and then finally, well, how is technology going to be changing this ecosystem and this investor participation in the future? So who am I? Why am I telling you this, and why should you listen to me? So I'm Dominic Stanyer. I'm from London. I moved to the Middle East a couple of years ago, but I've spent the best part of 20 years working in the capital markets for some of the large global multinational firms like JP Morgan, Goldman Sachs, UBS, Morgan Stanley. I have a PhD in computer science. I actually worked on cloud computing before it was even called cloud computing, and did my research at Edinburgh University many years ago. And I am, as Sagar said, I am the Accenture Middle East Capital Markets lead. So I look after all of the work Accenture does for our clients that are wealth managers, asset managers, sovereign wealth funds, broker dealers, investment banks, and exchanges. And you might not know what any of that means, but I'm going to touch on it all over the next 40 minutes or so. And hopefully at the end of this, if you didn't know what all those things were, you will at the end. And I should just end, if you don't know who Accenture are, we're a very large global technology advisory and services company. We work across all industries, all geographies, and we, you know, fundamentally prepare our clients for the future. Okay, so as I said, 3 areas I want to cover today. what are the capital markets? Who are the participants? And what does the future look like given the technology disruption that we see and work with every day? So what are the capital markets? So in a nutshell, the capital markets is here to help transfer capital. It's to move the capital that people have to the people that need it. And why do people need it? Well, they need it to do things. Governments need it to invest in infrastructure. Companies need it to build new offices, transform their technology, invest in training and staff. And the capital market is here to smoothly and efficiently move the capital in the world to the right people in order to progress and enhance the world that we all live in. However, there is one issue, and that is that the requirements that an investor have might not match exactly the requirements of what a seller might have, the people that need the capital. So for example, if I'm an investor, I may want my capital back after a certain period. I'm going to retire, so I need the capital back at that period in time. Or I may want my investments to be Sharia compliant, or I may want to only invest some of my capital in eco-friendly or sustainable projects. So I have a set of requirements, and similarly, the people that need the capital may have requirements. They may have a project that is over multiple years, and they may need funding now and in the future. They may not want to be linked to interest rates in terms of the return that they have to give back to the people that invested in, etc., etc. So there are requirements that both the people with the capital and the people that need the capital have, and the capital markets is here to align as best it can those requirements to enable the smooth transfer of capital. Okay, I'm going to use the textbook example. If any of you have studied the capital markets or read anything online, you may well have seen this example, but this is a classic example called the Midwest grain trade that basically was the introduction of the first derivative product. So back in the 1800s, if you were a farmer in the Midwest in the USA, it was the start of the Industrial Revolution. Things were changing rapidly. You had to pay the people that worked for you. You had to invest in machinery. You had to upgrade and repair that machinery. And you had costs through the whole year. However, your harvest only happened once or possibly twice a year. And you didn't know at a point in time necessarily how good that harvest would be, the quality of the harvest and the yield of the harvest. And therefore, you didn't know how much money you were going to get when you sold your grain. This caused a problem because how could you invest in the machinery and the people you needed in order to get it without knowing what you were going to get, and your ability therefore to pay off any loan that you might have got in order to do that investment. Similarly, if you were a cornflake maker and you needed grain to make your cornflakes, you didn't want to have to suddenly change your prices up and down to your customers in the supermarkets on the whim of how the quality of the harvest. You wanted to keep your product price flat throughout the year as best you could, within reason. So this was the problem. The cornflake makers with capital, the farmers that needed it, and these two different sides of a problem. So what the capital markets did, or what became the capital markets as a consequence of this, was they constructed a product called a forward contract, where both parties agreed upfront what the price would be for the corn at the harvest. Now, clearly, if you're the farmer you don't know what that's going to be. If the quality is high and the yield is good, the price could go up and could be much higher than potentially what you're going to contract. But similarly, it could be much lower. And so the farmer needed to make, a hedge, as we call it. They needed to make a decision around, well, can I support my costs based on this price for this future amount of corn at this point in time? And similarly, the cornflake maker could say, well, if I know I'm going to buy it at this price, I can therefore fix the price of my cornflakes. I can keep my customers happy, and I can, be the best in the market for my cornflakes. So this was the introduction of the forward contract. Very straightforward, very simple, but it wasn't, and as I said, actually, it's a form of derivative, because you weren't buying the actual corn, you were buying the right to buy that corn at a future point in time. However, a great product, very useful, but it did have a number of limitations in that you had to bilaterally find a farmer, if you're a cornflake maker, in order to do this agreement with. It was a one-to-one agreement. However, around the end of the 1800s, the railway formed and took shape and revolutionized, obviously, the industry in North America. And this meant that grain could move all around the Midwest, from Chicago to Kansas to St. Louis to Cincinnati. Trains could move, grain could move. And suddenly, this enabled a much bigger market for your cornflake producer. They could have access to many more farmers over a much wider range with different degrees of scale, clearly different weather, different problems, etc. So the market became much bigger because of this new technology called the train. And this meant that the cornflake makers had more access to the farmers, but also the farmers had more access to more buyers, for more investors, and more cornflake makers. And this meant that these forward contracts that traditionally were bilaterally agreed could be standardized. And because all the railways went through Chicago, Chicago became the center of this trading. And the Chicago Board of Trade was born, which fundamentally was a trading venue or an exchange that enabled the trading of these standardized futures contracts. Move it forward another 100 years, and the whole agri economy in North America is a massive part of the US GDP. About 5% of GDP, a massive amount of money in around $1 trillion. And since then, there's been a huge development on different products, different services that the capital markets has been able to provide to the whole of that industry. And our small example is just the first step on that journey. So if we kind of summarize this, the Industrial Revolution, the first 100 years or so of this graph, we saw the introduction of some interesting products that really helped facilitate the growth of farming, the scaling of farming, the machinery that was required, and therefore the increase in yields and food production that helped everyone to eat and survive in North America. However, in the subsequent 100 years, we had the digital revolution, and this introduced obviously computation, different ways of communication, data analysis, and lots of other new technologies which we will touch on later on in this discussion. And that has exponentially driven the size of the market. Okay, so we've covered at a very high level what are the capital markets. What are they there for? They are to move capital. They are to meet the requirements of the investors and the sellers as best they can to facilitate the movement of this capital in the most efficient way. But if we fast forward to today, the needs of our governments, the needs of our global corporations are vast. They need vast amounts of capital. And this provides a problem because no single investor has the capital, or very few investors has the size of capital required to meet the needs of today's corporates and governments. Therefore, an industry has formed that looks to consolidate the investor capital. And so companies that are wealth managers and asset managers, they look after the needs of us retail investors and our savings and our money and investments, and pool them together in order to allow us to invest in these large investments and projects that the world's governments and companies need. And similarly, hedge funds and private equity firms, they invest their own money in these projects and they look to maximize the return for themselves in a similar fashion. This is highly simplified, but this set of firms and services is what we call the buy side in capital markets. So these are the investors. These people are prepared to invest their capital and in return they buy a product. As I've touched on already, on the other side of the equation, what we call the sell side, are the corporates, the governments, the supranationals, so the world banks and people like that, that require huge capital in order to undertake the large projects that they need to, that are required by countries and regions to make all our lives better. They are supported by the investment banks who help them take their requirements in terms of the capital they need and structure it in a way that meets the requirements of the buy side. So just like a forward contract that looks to meet the requirements of the farmer and the cornflake maker, the investment banks are there to structure the products to meet the requirements of the buy side for the sell side. This is called the primary markets. So just like buying a new car, if you go to an Audi dealer and you walk in, you say, I want a red Audi with a furry steering wheel, leather seats and an electric engine, you can get a brand new car that you drive away with. That's a primary sale. You are the primary owner of that car. However, you have the ability to sell it on to someone else in the second-hand car market. In exactly the same way, the primary markets, once a product has been released and invested in, there is a secondary market. And this introduces a whole number of new investors and participants into the market. So as an example, if I'm a company that wants to float, so I'm a private company that wants to go public, I want to raise capital, I want to release the value that I've worked hard to produce by running a private company. I go to an investment bank who say, okay, let's value your company. You know, we think we can advise you that we think this is the value of your company, and we think the wealth managers, the asset managers, etc., the buy side will purchase your, will agree with our valuation and therefore purchase some of your company. And we will help you structure it into different types of equity or shares in that company. They will help with this initial IPO. That is a primary market activity. Once the IPO has happened, a share, in this example on the equity market, can be secondary, can be traded by other participants on the secondary market. The wealth managers can reduce their position in that stock, or they can increase it. And similarly, other participants who weren't involved in the IPO can participate. That is the secondary market. And underpinning the secondary market is a whole load of other firms and participants that are required. You need a trading venue, you need an exchange. In our example, that was a stock exchange. But if you wanted to buy debt, you would need to go to a debt market. If you wanted to buy currency, you'd need to go to a currency market. There's lots of different markets, lots of different venues. If you wanted to buy crypto, you go to a crypto exchange. But you need an exchange in order to have a secondary market. Traditionally, you've also needed broker-dealers. So these were intermediaries, and still are today, who are participants of the exchange and are able to act on your behalf in that exchange. And we'll come back to why we need broker-dealers in a second. You also need custodians. So to control and undertake the safekeeping of the transfer of ownership of securities. It's traditionally been quite complicated. It was paper-based, it's been digitized and transformed, but it's still relatively complicated. You need these participants in the market to help safeguard the transfer of those securities and the transfer of the funds behind those securities. And finally, a fairly recent introduction to the ecosystem since the financial crisis are what we call CCP, so the central counterparties that are there to mitigate some of the risks involved in this whole process. So in order to participate in this process, you need to have collateral. So you need to post capital yourselves to the CCPs that basically says, I am good for paying at the end of the day for all the trades I've made on the exchanges. Now, this is important because this is why the broker-dealer has traditionally been so, has been required and has meant that someone like you and me have found it hard to trade directly with exchanges. They have had to have a large amount of capital in order to post their collateral requirements with the CCPs in order to perform the activities that they want to do on the exchange. And this underwrites the risk that you do a trade on the exchange and then you can't pay for what you've bought. This is, again, highly simplified, but it gives you a picture of a number of the key participants that are required for a secondary market. And it highlights the need for a large amount of capital to perform within the secondary markets. So put that all together, you have a complex ecosystem with a lot of different participants doing a lot of different things. But fundamentally, it all comes back to people with capital, transferring it to people that need capital, and a capital market that tries to balance those requirements on both sides. So we saw at the end of the Midwest grain trade that the size of the market has been exponentially growing. Similarly, the complexity, the number of participants, the intermediaries has also been exponentially growing. This growth, and I guess where we are now leading to in this discussion, has been driven by technology and driven by innovation. However, we feel now that we are at a tipping point where technology now is looking to flatten out this curve and actually become a bell curve and start to reduce the complexity, reduce the capital requirements, and increase the efficiency of the markets. And this is an inflection point in the capital markets, and it is the key enabler that is going to allow more participants, less intermediaries, and the access to many more products for the retail consumer, so for you and me and our families, that to date we have not had access to because we've been prevented from participating due to the lack of the requirement for huge capital to participate in these markets. Okay, so as I've said, there are a set of key challenges that we see today. This highly complex ecosystem, large amounts of intermediaries, and this large capital requirement to participate in the markets. Where technology is now starting to act within the capital markets or start to affect the capital markets is around driving more efficiency, opening up access, which in turn is democratizing the participation. It is allowing more of us to participate in those markets. And as per the name of the kind of presentation, technology replacing capital, it is shifting the need of the participants to be capital intensive. So what are the technology enablers that are going to facilitate this? I've picked a few here, and they're at a very high level. But let me whiz through them and how they might affect our kind of three key dimensions of efficiency, democratization, and reducing the capital requirements. So we have big, and I know you have further sessions on some of these topics. So I'm not going to dive into any details around the technologies. I know there's another session on blockchain to come, so I encourage you to join that one. But if we go from sort of right to left, if we look at big data, the use of big data now in the capital markets is profound. It's used both on the buy side and the sell side, and it is increasing the transparency in the markets. It's getting us a better understanding globally of where and what a price should be for a product. So the dark pools that used to exist, where people didn't really know what the price of a product was, are being removed because of the use of big data to really understand and uncover the global pricing, basically trying to simplify the complexity that is there around how global pricing works. And this is making us improving the accuracy of how we price, how we manage risk, and driving significant efficiencies through the capital markets. Secondly, we have algo trading. Again, this is driving better pricing, faster pricing. It's removing the need for you to ring up your broker to execute a trade for you, determine the best price and come back, which in turn is meaning that it's democratizing the use and participation in the markets. It's reducing transaction costs by taking out a expensive manual layer. It's removing unnecessary intermediaries, and it's reducing the impact of what we call sort of fat fingers. So mistakes that humans can make that can drive problems in the processing of trades in the market. We then have open APIs. So just like open banking regulations and initiatives that have taken place, the capital markets is the same. The use of open APIs has facilitated direct market access, obviously of other technologies, which in turn is what has enabled us to pick up our phones and do a crypto trade or equity trade without the need for either talking to anyone or going through some of these intermediaries and participants. This is a ever-changing landscape and a very big theme that is now driving change across the capital markets. And it is one of the key reasons why and enablers for fintechs in the capital markets to participate. So as a fintech, just like a participant, actually, it's very difficult. The disruption of fintechs in the capital markets has been much more difficult than in banking because of the huge capital requirements that have been required to participate in the market. Initiatives and technologies like open APIs are starting to change that and are starting to enable the fintechs to participate much more fully and delivering much more impact than they were before. We then have artificial intelligence and deep learning, again, very heavily related to the big data, but we are seeing huge and significant progress being made in our ability to analyze risk and therefore manage risk. And this in itself helps reduce the capital requirements. If we can understand the risk better, we can calculate the risk better, then in order to hedge that risk and manage that risk, we can be more accurate in what are the capital requirements that we need to underwrite it. So that also dramatically reduces this requirement for capital and drives efficiency through all of our processes. One of the use cases that I've been working on actually is using artificial intelligence to understand the processing through the complex ecosystem that we've touched on and talked about, by using it to interrogate all the communications that happen and to learn when a mistake is made and how that drives an exception in the processing of a trade. So a lot of these technologies are in use today and they are driving real change in the participants of the capital markets. Finally, we have blockchain on here, or more accurately, distributed ledger technology. As I said, I'm not going to go into this in too much detail, given you have a separate talk on it coming up. But fundamentally, a distributed ledger enables a single version of the truth of a trade to be recorded and to be authorized by the participants. And this means at any point in time, we know exactly who the owner of that trade is, or the asset is. We know where that asset is, and we know the value of that asset at any point in time. So this has the potential to absolutely transform the capital markets, because a lot of the issues we touched on so far have been around the risks involved in saying you will buy an asset and then paying for that asset. And if there's a gap between those two things, there is risk that that payment won't happen. Therefore, we need capital, we need collateral. It's one mechanism for managing this. There are others, but there is an inefficiency in the market that is introduced by this. Distributed ledger technology is the potential to remove that ambiguity, because at any point in time, we know exactly who owns that asset. And so as soon as it's traded, that asset ownership can change. And there is no dispute. We can transfer the funds for it, et cetera, and that can significantly simplify and significantly reduce the capital requirements required to participate in that market. And we are seeing the introduction, therefore, of digital assets backed by a blockchain or a DLT infrastructure as potentially the future of our markets and the future of our infrastructure that we are going to use. So We know that cryptocurrencies, we know that Bitcoin is traded on the blockchain. That's the version of the DLT it uses. And we know it doesn't have some of the same challenges around safekeeping, custody, and collateral management that a lot of the other assets do because of this use of technology. Now, clearly, there are very simple assets, and there's other complexities in applying that technology to some of our other products in the capital market. But it is one of the key areas where we see real transformation and a real enabler for our three key dimensions of reducing the capital, democratizing access, and driving efficiency. Okay, so maybe in conclusion, I guess the way I like to kind of look at the evolution of the capital markets, we've seen how it has changed, how technology has always been central to it, but the evolution really has been people, capital, technology. So traditionally and originally, to participate in the markets, you needed to know people. You needed to go to the coffee house shops. You needed to find the right farmer. You needed people relationships in order to do the deals, to secure the movement of capital. Over time, and because of the technology advancements, it has become the case that actually you need capital to operate in the capital markets. The biggest players dominate the markets. They make the most money. They determine the transfer of more capital than anyone else. Hence, we've seen this huge explosion of the really big JP Morgans, UBS's, Goldman Sachs of this world that can dominate their participation in the markets. It was the age of capital. Now we are moving into the age of technology. We're already in the age of technology in cap markets, but it is slowly starting to address these challenges, and it is slowly becoming the case that it is the leaders in technology that are going to be the winners in the futures, not the people with the most capital. Okay, I'm going to stop there and open up for questions.
Dominic, thank you very much for a great presentation. I think you've really helped simplify quite a complex area for the audience, and I've certainly learned a lot about capital markets from this. So thank you again for giving you in-depth knowledge. We do have quite a few questions. I'm just going to run through a few of them, if you don't mind. So one question, I guess, related to this theory, this principle that technology is reducing the complexities of capital markets. What does that mean for the sort of the different players in the capital market? So are we going to see intermediaries going out of business? Are we going to see new players developing from this? What are your thoughts on that?
I think it's both. I think we it's going to take time. these are embedded processes, institutions, and markets. And if you think about it, the big bang in the 1980s, which was the digitization and the first kind of use of computers that revolutionized the markets, it's still taking, we still have open outcry exchanges. If you ever get a chance to go to London, the metal exchange in London, you can go and visit it. You can go and sit up in the visitors gallery, and you can see people in the copper markets and the nickel markets standing there shouting at each other, trading these commodities. It still exists today, despite the fact that the technology has moved on and lots of other markets have gone digital. So it will take time to change. And I think we will have a world where we will run in parallel with our traditional markets, with some of the traditional intermediaries and inefficiencies, but there will be new digital markets. How effective how quickly those new digital markets with digital assets, probably based on DLT, will take over from the traditional exchanges is still uncertain. I do think it will happen, and I think it will converge, but I anticipate that what will happen is we will see new participants, or at least new venues, maybe run by the existing participants, but new digital venues trading digital assets that will be much more efficient, require way less capital to participate, will open up investing to people like you and me and people on this call in a much easier way, and give us a vast or a much wider range of products to invest in. Hopefully that just about answers.
No, it does. Thank you. And there's a sort of a follow-up question to that around you mentioned about digital markets, and that touches on crypto as well. So not necessarily talking about the merits of trading crypto, but more so in terms of how do you see the capital markets evolving for cryptocurrencies and digital assets? Is it something which things like DeFi will be playing a bigger role in, or are there other particular strands which you think will be evolving?
Well, exactly related to what I said before, my view is that the digital assets, we will see an explosion in digital assets. And I guess the critical point from my perspective remember, I'm on the kind of corporate advisory side of this, is that we will see regulated digital assets. Now, the thing about crypto is that it's currently an unregulated market. I think the big switch will be that we will see a huge increase in regulated digital asset markets. And why are digital assets good? They're good because of all the reasons we talked around efficiency and the markets that they work in, but also they're very easy to fractionalize. So you can chop up products into much smaller pieces and manage it very easily, unlike the traditional kind of markets. And again, this means that it can be chopped into smaller pieces. It means that investors with less capital can invest in them, which opens up markets and products to people and places that haven't traditionally been able to work on it. So for me, it's the regulated digital asset space that we're going to see. It's definitely going to explode in my view, and it's definitely going to become kind of the norm. Crypto is a slightly different discussion, but the digital asset, regulated digital asset, the technology is very similar to crypto. We're borrowing a lot of the learnings and the thinking that's happened there, and it wouldn't surprise me if some of the participants in the crypto exchange in the crypto market don't participate in the new regulated digital asset market. And I could see them becoming big players in this and actually taking out some of the existing incumbents in the traditional markets.
Absolutely. And I guess talking about new players, are you seeing any particular projects or fintechs which are looking to utilize some of those technologies you mentioned to disrupt and change capital markets? And I guess the follow-up question related to that is the change going to come from fintech innovators, or is the change going to come more from regulated and the exchanges?
Yeah, that's a good question. So again, Accenture actually over the last 15 years, I think I've been involved in what we call fintech labs at various parts in the world that we've helped run or facilitate or participate in. So I've seen hundreds of really interesting fintechs using all those technologies we talked about: AI, blockchain, big data, all of them. Really interesting, really innovative. But it's fair to say, not all, but a lot of them have struggled to really disrupt the capital markets. So if you look at retail banking, we have seen new banks created, neobanks created completely on new technology that have come into the market and have significantly disrupted some of the big incumbent players. In the capital markets, we haven't really seen that in the same way. And it's because of this problem that you need huge amounts of capital to participate. And so the kind of, if I look back at all the fintechs I've worked with, some have been highly successful, but a lot of them have been invested in or consumed by the current participants. So as a fintech owner, that's great. They can make a lot of money, they can be very successful, but they haven't, they're not toppling JP Morgan and Goldman Sachs or the London Stock Exchange at the moment. Could this change? Again, I think that's the direction of travel. As things simplify, as the requirements become less, I think it will become easier for fintechs to really make huge impact. And I think the digital asset market is the space where we're going to see real disruption. That's not to say lots of the fintechs are not doing great things and being very successful and bringing new innovation. They are, but they're just not disrupting the real kind of ecosystem of the market.
And then bringing that back to Saudi, I guess, what are you seeing in terms of the Saudi capital markets? Any in terms of innovative developments you're seeing with Tadawul and the new things which they're looking at, and what's preventing greater innovation in the Saudi capital markets in particular?
Okay, I have to be a bit careful. I work quite closely with Tadawul, so I have to be a bit careful. But so the Saudi markets are interesting in that the challenge the Saudi market has is the lack of international investment in it. There's a lot of internal investment in Saudi. There's a lot of money in Saudi. The Tadawul is a very big exchange with a huge amount of market cap on it, given what's listed on it. It's very successful, but fundamentally, Saudi needs to attract more international investing into the country. So the innovation I think we're going to see are products that attract international investors. And again, without giving anything away, or partly because I don't know most of it, but things like clearly Saudi is a hydrocarbon producer. Clearly, this is an energy-rich region. It feels to me that is a great opportunity for the region to play a significant role in the energy markets, or a much bigger role in the energy markets. And whether that's the sustainability angle through green search or carbon products, whatever it might be, I see that I could see Saudi being very central to a future digital carbon market. That feels to me like it would fit with some of the key dimensions here, and the point being that could attract international investment into the region.
Yeah, no, absolutely. And I think things such as joining MSCI and just a general internationalization, G20, of course, as well, all those sorts of things are putting Saudi on the map more and more. And how do you see the regulatory environment for capital markets in Saudi? Is it comparable internationally? Do you think, in fact, there needs to be reduction in regulation to attract this capital into the marketplace?
Well, there's been a lot of change over the last few years that's made a significant impact already. I don't see it as the key barrier, if I'm honest. I think the regulation is pragmatic and is pretty flexible, and has the best interests of Saudi behind it. So I don't see that as being the barrier. I think it's picking the right areas to go after to attract the international audience, and then having to deliver the infrastructure to support it, which is not easy, but will be required.
Great, and I guess I've got one last, I guess, technical based question. Is around using using capital markets for assets which historically were not liquid. So things such as asset-backed tokenization, providing a secondary market for, say, equity crowdfunding and private equity. Are these things which you see being developed as part of the capital markets? And if so, how do you think that will evolve?
So yes is the simple answer to that. So yeah, there's two things. One is there's just the liquidity of a product. Do people want to buy the product? Is question one. But then question two is, do they have access to buy it? And it goes back to our democratization theme. Actually giving more people access to that product will in turn drive the liquidity of the product. So assuming there are people that want it, that have a barrier to entry into it. So all of the digital asset theme, the fractionalization, crowdfunding, these are all ways of allowing the smaller investor to participate in products that they couldn't participate in before, and that in itself will drive liquidity. So I am a big believer in that, and I think that is that is the future, as we've just discussed, of where the capital markets is going and how it's going to service all of our needs, both as investors and then as citizens of the world that need this capital to improve our lives.
Excellent, thank you. I think that's covered quite a few of the questions, so appreciate your time, Dominic. I guess one last question is for anybody who's listening to this. They're hearing about maybe capital markets for the first time. What would you suggest for somebody who wants to learn more about this area, maybe get involved from a career perspective? What steps do you think that they should consider?
So it is a very difficult industry to understand, as maybe we've demonstrated today. But and it takes a bit of understanding. It's not something that you kind of leave college saying, "Oh, I really want to be working operations on an exchange." It's just not something that's natural. So it does take a bit of research and a bit of work to really understand what it is that the capital market does and why you want to work in it. But fundamentally, the point I would make is, as we said, it's gone from a very sort of people-based industry to a capital-based industry to now a technology. It is a technology-led industry, and a lot of what it does is not seen, is not understood or perhaps heard about by the general public, but it is very advanced in the technology, the application of technology. So if you're interested in technology, if you want to work in an industry that moves fast, that invests heavily and quickly, then it is, it's one I would recommend looking at very seriously. In terms of entry, again, I think there's lots and lots of different ways in. As you saw, there's lots of firms on the buy side. There's lots of firms on the sell side. There's lots of infrastructure that supports it. So there's lots of options to go after out there. And I think all give you a good grounding in this. The people I work with have worked across all sides and all parts of the industry. So it's a very flexible industry. Once you're in it, it's quite easy to move around across it. So I guess get out there, see who's recruiting where, and if it's something you're interested in, if you have a real technology love and innovation love, then it's somewhere I'd recommend. Excellent.
Thank you, Dominic. Sorry, there is one question from Ali I've missed, and apologies, Ali. I just wanted to ask this because we've got a couple of minutes. It's again another technical question, but how similar is the concept of algorithmic trading to the ones being practiced in the DeFi world? Can we view automated market maker as a viable replacement to brokers and order books?
I mean, at one level, they're the same thing. So yes, I think it's the answer to the question.
Right.
And I think we're already seeing the replacement, the automation of the order books. So I do see that as that's the ultimate future of where we're traveling to, and I think we're going there very quickly. So I mean, the answer I think is yes to directly to that. I think it's the same thing, and I think it's happening now around us.
Very good. On that note, Dominic, again, thank you very much for your time. I really appreciate your guidance on this area. And we look forward to future collaboration with Fintech Saudi and Accenture as well, and getting you more involved with some of our activities. And everyone else, thank you very much for joining for week 7. We've seen a few questions about how many weeks are left. So we do have 3 more weeks left. We've got week 8, week 9, and week 10. We are continuing despite Eid. We're going to be having another session next week. Next week, we'll be covering personal finance and wealth management and wealth tech. So again, another session where you will get a great overview and understanding about a really important area of financial services. So thank you again for everyone for your joining. Thank you very much for your questions. And we look forward to seeing you again next week. And Dominic, again, thank you very much. And we look forward to catching up soon.
Thank you.
Thanks, everyone. Take care.